Thank you for joining me in another episode of Breakaway from the Rat Race. I have another great show for you following this, but I wanted to let you know that I have finished writing my first book, this way, called Stop Trading Your Time for Money. So, this is a how to guide for the middle class to achieve financial freedom, do early retirement, leave a legacy for your children. So this book is available for free for a few more days. If you want to get it, it's on Amazon, obviously. But if you don't know where to find it and stuff like that, you can go on my website. It's called marteleric.com and then // book. And then in there, you're going to have a button that you can click and it's going to bring you to Amazon to the book. You can obviously search it on Amazon. So stop trading your time for money. And yeah, by Eric Martel. So I hope you enjoy the book. It's free again for another couple of days. So please download it as soon as you can. And then that's it. Let's get to the show. Well, welcome to another episode of Breakaway from the Rat Race. And today I have the honor to meet and discuss with Brian Adams, who is the president and founder of Excelsior Capital, where he is spearheading the investor relations and capital markets arms of the firm. Hi, Brian. How are you doing?
I'm good. Thank you so much for having me.
Oh, my pleasure. So tell us a little bit about kind of like your background, and I think that some of the listeners may not know exactly what you mean and what is meant when we talk about capital markets and investor relationships. So tell us a little bit about kind of like what you do every day, and yeah, what you do every day.
Yeah, absolutely. So, as a brief background, I'm a New Yorker who married a Nashville girl. I moved to town about 15 years ago. I'm a recovering attorney, so I practiced law for about 4 years, and I got into the business because my wife's family has a single family office based here in Nashville, and
Okay.
they had invested in commercial real estate over the last 25, 30 years. And so, as I got exposure to some of the investments we were making, and the sponsors and the general partners we were working with, along with fund managers, I thought it was a great business and I wanted to get involved. So
Mm-hmm.
started the company about 10 years ago, and over that time have amassed a portfolio of commercial assets across multiple markets. And we can get into all that if you want.
Mm-hmm.
In terms of capital markets, investor relations, and how I spend my time, at this point, we have a portfolio of around 2.5 million square feet, and we're in 12 different markets.
Uh-huh.
So we have 12 employees, and we're very fortunate to be able to have folks that only work on asset management, people that only work on acquisitions, that we have a
Yeah.
controller, et cetera. That being said, as you know, and as your listeners know, commercial real estate is a very capital intensive business. And so
Mm-hmm.
I spend the majority of my time reaching out to prospective investors, working on our marketing efforts. And that involves, investor relations, communications, reporting, increasingly doing a lot of content creation, inbound marketing techniques. Given COVID, I'm not able to travel as much as I used to.
Yeah.
And so that's where I spend the bulk of my time, frankly.
Mm-hmm. Yeah, I think that's very interesting. Yeah, we always, whenever you're in real estate, and I think most of our listeners can relate to that. It doesn't matter what level you're at. You're always somehow are raising money for one reason or another. One reason or another. There was one guy, an investor in Canada, who used to say that it doesn't matter how much money you have, you're always short a couple of millions. And
Sounds
that's
about
so
right.
true.
Yeah.
And that's so true because we're always kind of I mean, everybody, all the investors that I know, we always kind of like reaching just slightly out of our reach in order to grow and expand. And then so we always have to be maintaining good relationship and build the network all the time, whether we need money or not, because we know that eventually we're going to need money. We're going to find this unicorn of a property that we must have, and we want to be ready to get the investors involved in there. I have a question also that maybe some of our listeners may not be aware of. If you can define for us what a single family, a family office is.
Yeah. So this is going to be a difficult endeavor. It's very hard to define. The best way that I've heard it described is a family office is a corpus of assets. So, a bucket of money that is meant to provide and maintain a certain quality of life for an exponentially growing family over multiple generations and avoid paying taxes.
Mm-hmm. Yeah. So
So,
what?
in
Yeah, go ahead.
practicality, that just means that you have enough money that you're essentially running your own wealth management business,
Mm-hmm.
and your only clients are your family members.
Mm-hmm. Yeah.
And so it's really a mindset as opposed to a dollar figure, because there are plenty of high net worth individuals and families that simply don't want to have a single family office, because it's essentially having a small business
Mm-hmm.
underneath your family. And it has a bunch of pros and cons that we can get into, but I think that's
Yeah.
the best way to put it.
Yep, and so this is what I'm doing as well. Is I'm building this company, this corporation, for the family. So all the family members are part of the corporations, and then our goal is really to kind of like not only provide for the lifestyle of the current family members, but also looking at future generations, and then making sure that they are successful as well in their life endeavors and stuff like that. One of the probably the most famous one that did the family office, or maybe even started this, was Rockefeller, I believe. So that's
Yeah,
and so you have,
he's considered the creator of the family office concept. And they
yeah.
still have a pretty robust multifamily office today where they service
Mm-hmm.
their own wealth as well as other families.
Yeah, yeah. So that's very good. So thank you for sharing that with us. So let's dive into some of the topics. I think that that I want to hear from you. Your perspective is about the market. So the secondary growth market. We also talk about the different in terms of the demographics of the market. Everybody is wondering, where is this going? Are people leaving the cities? Are they staying where they are? Where's what's going to happen with the markets, and where should I invest? Should I invest in secondary market or stay tight on my primary market?
Yeah. So let's do some definitions first, because I think it'll
Mm-hmm.
help.
Yep.
What we define as a primary market is a top 10 gateway market. So think
Mm-hmm.
New York City, Chicago, LA, San Francisco, Houston, etc. These are big cities, right? Very dynamic places. They're very expensive. But over the last, call it since '08, they've done very well. A lot of people have moved there, etc. For us, we've had an investment thesis that we think this maturing millennial generation, which is roughly 75 million people today. I'm barely qualified as a member, but I do. I'm just on the very front edge of it.
Mm-hmm.
It's now the largest working generational cohort in American history.
Yep.
And for a long time, there was a narrative on Wall Street that this generation of people would live in Brooklyn, wear skinny jeans, eat avocado toast, and live in an apartment building, never have children, never get married, and they would stay in Brooklyn forever. What we started seeing is that clearly wasn't the case. Because of 2008, that family formation phase got pushed back 3 to 5 years than what traditionally you would see. So they just didn't have the economic wherewithal to do it. But it was occurring pre-COVID. And because of that, that generation was making a choice about where they want to live, work, and play based on cost of living, quality of life, and access to single family homes and education for their children. And when you kind of take all that into account, secondary suburban markets make a ton of sense for them in terms of solving all the problems that they were facing. So we were seeing an exodus and a demographic shift out of primary markets to secondary markets pre-COVID. And I think what you've seen post-COVID is that trend line has just accelerated dramatically. And when you think about where to put your money, where to invest, historically, for any aspect of commercial real estate, it doesn't have to be office, it could be multifamily, et cetera. It's all about population growth and job growth. And so if you think demographics are destiny, which we do, following where people are moving, should be a real tailwind for commercial real estate investing.
Yeah. So some of your best secondary market, I would say, for you that we should be looking at and focused on? What are they? What should they be?
Yeah, it's hard because some of the ones that I think are the most exciting are also very expensive. So in my own backyard in Nashville, if you look at Nashville, if you look at Raleigh, if you look at Austin, these are
Yeah.
all sexy markets that we'll hear about in the headlines. They're still considered secondary markets, but I personally think there's not a lot of value left to be had there. And so we kind of go to the next level, and we're in places like Richmond, Virginia, Cincinnati, Ohio, Kansas City, Kansas. Looking at
these are
some of
good
those
cash flowing
places.
markets as well. So our thesis is on we're looking for, or strategy is really to look for cash flowing markets, cash flowing properties with some kind of increase in population. So good population, good GDP growth and stuff like that, but not something that's sustainable. So we're not looking for something that's growing like 5% or whatever. We're just looking for like just a slow 1% growth so that all the infrastructure and everything can be built. And we don't end up in a situation where we have too much higher demand and not enough supply. And then the market goes, the value goes too high.
That's right. And I'll caveat that with my prior statements of our investment thesis is all about capital preservation and cash flow. So we're not swinging for the fences. We're not doing development. We're looking for stabilized core plus passive income type investments. And, are we missing out on some upside by not being in Austin and Nashville? Certainly. Are we also taking some risk off the table? Yes. But that's just our investment thesis and strategy and what our investors want. So that's why we're in these markets.
Yeah. And I think it makes sense because your investment horizon, I would say, I mean, you're looking at multi-generational wealth. So you're looking at your generation, you're looking at your kids' generation and your grandkids. If you go for some of these markets that are super expensive right now, I mean, you don't know exactly where they're going to go, as opposed to some of these markets where they have a solid cash flow basis that you can really kind of ride for multiple years. I think this is, for me, I mean, obviously, that's what I think is a great strategy for long term. And then, yeah, it's going to grow in value over time, but I'm not worried about, the Austin market is going up or San Francisco market is going up 11% or it's going down or this other market is going down or whatever. I'm really focused on the long term. And when you look at the long term, then it kind of all smooths out.
Yeah. I mean, we tell people, look at this as a 10-year investment horizon at a minimum. And, the nice thing and the difficult thing about real estate is that there's no scoreboard. It's not the stock market. You can't really do a mark to market every day. And I tell my investors, you shouldn't even really look at things on a monthly or even a quarterly basis. You should probably look at things annually, right? How's the asset performing? How's the market looking? And the nice thing is you can't just trade out of the deal. You can't just sell the building once you get scared or nervous or you think the end is coming. It's illiquid for a reason. And that's one of the best things I think is you should be looking at this on a long-term time horizon. That's right.
For a lot of the people that we're investing, the investors that I speak to, I mean, they're just getting started. So we're recommending that they start with single family rentals. So that's a good asset class. It's easy to manage, easy to handle. And then you have a little bit more liquidity. If something goes wrong and stuff like that, you don't have to get rid of a 50-unit apartment building. You can just sell one house out of your 10 or 20 house portfolio, and then you can get your cash flow back on track or something like that. So that's one of our recommendations. A little bit more liquid, easier to kind of like rebalance your portfolio if you have to.
Yeah, I don't disagree. I think if you want to get into the business, single family homes and smaller multifamily kind of quadplexes makes a lot of sense because if you're investing in your own backyard, you understand the dynamics of the market really well, probably. Where people live, where people go to work, where their country clubs are, where their schools are. And we've all lived in a single family home, probably, right? Or we've all rented an apartment. So you can understand those dynamics. I think once you look to diversify, that's where working with a sponsor or a fund probably makes more sense. But yeah, I think getting into the business that way makes a lot of sense.
Yep. So thank you. The other thing too that I wanted to say, so you are mainly your portfolio are mainly commercial, or do you have also like apartment building that you have rentals as well, or just commercial?
Just commercial, mostly
Just
suburban
commercial.
office. Yeah.
Okay. So how do you think, so suburban office, okay. So yeah, so that's kind of one of the topics too that I was very curious about is kind of what's happening. We talk about here in San Francisco, the Silicon Valley is kind of shifting, and we're not sure where it's shifting to. Is it just going to be people are going to be working from home on the outskirt of Silicon Valley or here in LA, Silicon Beach? Or are they going to go and say like, go to an office, but it's going to be somewhere completely different, like Austin or Pittsburgh or something like that. So what are your thoughts on that?
Yeah, I mean, I'm biased because I'm a big believer in office, right? So let's
Yeah,
just put that out there, and I'm not afraid about it.
yeah,
And I think, not to condition my response, but I think it's important to put some perspective and some framework around the answer. We all suffer from recency bias. So for a lot of
yeah.
us, the way we've lived the last 6 months, we forecast that that's the way we're going to live for the next 6 years. And that's
Hmm.
typically never the case,
Yeah,
not just about commercial real estate, but about a lot of things. And what we've seen is this work from home phenomenon, this forced experiment. At the very beginning, there was a lot of novelty involved. People were afraid of losing their jobs. And so productivity was really strong.
yeah,
What we've seen post Labor Day is productivity drop off. Burnout has become real and it's kind of worn thin on a lot of people.
yeah,
Um, and many employees don't really have, I'm very fortunate. I live in a big house, I have my own office. I can be productive. My children are in school.
yeah,
That's just not the case for a lot of people. And
yeah.
so
That's
I
true.
think what you'll see is, will the way we use office change? Absolutely. I think the trend line of the WeWork model, where you had 75 square feet per user in these really tight spaces that were really
Hmm.
expensive build outs, I can't imagine that's going to be the trend moving forward. I think the pendulum will swing the other way.
Yeah,
You'll have more traditional office layouts of 250 to 350 square feet per user and more typical traditional closed office setups.
yeah,
So hoteling and hot desking and these things, I don't think they make a whole lot of sense. And
hmm,
then, I think there's a difference between working from home and remote working, and drawing that distinction is important here because when you actually read and see what Facebook and Apple and Amazon are doing, they're not saying work from home. They're saying not everyone's going to be in San Francisco anymore.
yeah,
We're going to spread the workforce around. We're going to have more economic options for people, and we're going to be closer to where our employees are living. And I think
yeah.
that's the key.
Hmm.
So, will office change? Yes. Do I think it's going to be a secular shift like retail, where it's just going to be a dying asset class? I don't believe that. I think it'll still be a fundamental part of our professional lives.
Hmm. Yeah, I think that I mean, I think for some of the big in the Silicon Valley area, I mean, there was in San Francisco, there was a lot of commercial projects that were going on, and then and when these projects were being built, they had a set of assumptions as to how many people they would fit, how many employees would fit into this. And then they were still into this kind of like the we work mentality of, oh yeah, this is open space. This is so great that you don't have dividers and all of that. And you can look into each other's eyes as you work. And then, and it's like now with COVID, it's a little bit like, okay, well, I don't really feel like that anymore. I want to have a little bit of a barrier and blah, blah, blah. And I want to have a little bit more distance. And so a lot of these assumptions are kind of shaken a little bit. If you were pretending that you have so many employees of occupancy in an office building, now all of a sudden it's like maybe it's only going to be 75% of that or maybe 50% of that. You're going to have to put so I agree. I think there's still a lot of companies that see it as being very important to be somewhat co-located and being able to meet somewhere. And I think, yeah, they're gonna explore a lot more options to be outside of the normal areas. And I think they were already doing that anyway. If you look at here in LA in Silicon Beach, you have Google build a campus here, Facebook build a campus here. So there's a lot of high tech companies that did that. They did the same in Austin, Apple and all of that. And then in Pittsburgh as well, there was so they were already doing that because it was getting a little too expensive, and now you kind of spread out. If you think
Yeah.
of Corona as if there's going to be another Corona or SARS type um, virus, maybe 5 or 10 years from now. So you want to de-risk your population or your employees being sick. So I want to spread out my employees, I think, in order to, so at least if there's a big crisis somewhere, then my employees are all spread out and I have a better chance of keeping my intellectual or my intellect, safe and healthy. So I think that could play as well. I think on the in how these companies are going to invest in the commercial space.
Yeah, and if you look at not what what big tech is saying, but what they're doing,
Mm-hmm.
they've been gobbling up office space in New York City at a
Mm-hmm.
really good clip. They're getting great discounts on some leases and some buildings. And right now, the current number is about 225,000 more employees in the city than they had pre-COVID.
Oh, really?
So
Wow.
they clearly believe that that is going to be a fundamental part of their business, and how they
Yeah.
create value moving forward is that creativity and that collaboration that you were talking about.
Yeah. 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 So I think that, yeah. And if you're positioned right now into a secondary market, like a smaller market, and you have commercial space, so you could be pretty well positioned because as these, if you have a company in San Francisco and now all of a sudden I want to shift like 10,000 employees outside, then you're not going to have 10,000 employees very often kind of moving into a little town. And so now if you own a little bit of commercial space in these smaller markets, I think, yeah, you could be doing very well. I think that'd be a very good move. So that's what you had in terms of the kind of like so that's what you saw in terms of the rebirth of the suburban office. And then, but still, it sounds to me like it's still pretty close to a major center, right?
Yeah, these are typically MSAs, so metropolitan areas with a million plus population.
Okay.
MSAs can be a really squirrely figure that
Yeah.
people throw out there. It can be a chamber number that's much bigger than you think. But yeah, I mean, our investment thesis was, or part of it is that every generation rejects their parents' way of life until they get married and have children, and then they want the same lifestyle that they had growing up. And so my parents rejected, in the 60s and the 70s, they would never live the way that their parents did. Well, guess what? They all moved to the suburbs. They all had cars. They all sent their kids to the same school. And I don't think millennials are any different. For a lot of them, they rejected the way of life that they had growing up. But once they started having children, they didn't want them growing up in Brooklyn. They wanted them to have green grass, buy the SUV, send them to the great school, have all the opportunity. And, I think suburbs and secondary markets, called the boomerang generation, I think it just makes a ton of sense for them.
Yeah. The other thing, but when we look at that, I mean, they were talking about, again, I'm pretty familiar with kind of like the dynamics in San Francisco, but they're talking about, there's all these people are moving out of San Francisco and they're going to Lake Tahoe, which is like 2 or 3 hours away, or they're going to kind of like Napa or some of the suburbs and stuff like that. But the capacity for these secondary, well, I'll call them secondary market, but I think based on your definition, they're probably even like tertiary market. For the capacity for these small markets to absorb 10,000 new families is not feasible. And you can see right away that these markets are booming right in terms of prices. They're not booming in terms of volume of inhabitants. They're just booming in that the prices are shooting through the roof because there's no way for it to absorb all these people. So there's these bidding wars going on. So, and that if we're going to do this, if there's going to be a shift and people are going to go there, that means you're going to have to do a lot more development in these areas, right?
Yeah, I don't disagree. I mean, I think what you see I have much more connectivity to the Northeast. I'm from New York originally, and I have a lot of friends still in the
Yeah.
city. And what you're seeing now is, you know, how do you 3x the classroom sizes for these schools in the Hamptons or in Westchester County or the Hudson Valley, where all these
Hmm.
people from the city have migrated out to? It's a real challenge.
Yeah.
And there's no easy solutions there other than tax them more and, build, but it's going to take time. And, frankly, you kind of wonder, are they going to build these bigger schools just in time for everyone to go back to the city? I mean,
Yeah. Yeah.
part of
Yeah.
my own thesis is places like San Francisco and New York, I think every 20 to 30 years, they get too expensive. There's some kind of price reset. Everyone leaves. They get gritty again, but they
Hmm.
become affordable for a younger generation to come in and become energetic and create businesses and, get coffee and that kind of thing. And
Yeah.
then it just kind of keeps evolving. Cause I grew up in New York in the 80s and the 90s where it was an awful place. It was dangerous.
Yeah.
It was dirty. Nobody lived there. And it kind of changed, right? So I think we're just kind of in that part of the cycle where it's the natural progression of things in some ways.
Yeah. Yeah. Well, I think the pandemic maybe accelerated some of that like dramatically, and that because it accelerated that, then I think it makes it harder now for that to actually happen. Because maybe on a natural cycle, let's say you're saying like every 20 years, there's kind of like, okay, well, this is too expensive. And I think we were kind of getting to that in San Francisco. People were kind of thinking before COVID is like, okay, well, this is a little bit too expensive. I'm going to look somewhere else. And in fact, I moved to LA. This is not exactly the reason, but this is one of the components of why we moved to LA, because it was a little bit cheaper. But yeah, no, maybe the natural cycle would have been that X number of people would move out of the city and then go to other areas, and then that would kind of start the beginning of a trend. But now with the pandemic, instead of being X people moving out of the city, now it's 20X the number of people that are moving out of the city, and then the suburbs can't handle that. So that's going to be interesting to see how this evolves. But yeah, that's going to be very interesting. So the other thing to that, so about that. So in terms, you don't own any multifamily. So, but it sounds to me like maybe some of these markets, the people that are moving out of the cities, they're not looking for multifamily in secondary or tertiary market. They're looking more like for single family to raise their family. And is that's what you're thinking is?
That's what we're thinking. I mean, we don't
Hmm.
have any exposure to residential, so I don't have a dog in that fight. But I
Yeah.
personally think single family rental and single family just purchase makes a lot of sense for these people who are
Yeah.
leaving these major metros and been going from an apartment. I think they want the space. I think they want the privacy. I think they want the access to the outdoors. And so maybe high end condos would make sense for some of them. But I do think that single family rental is a
Yeah.
great play right now. We've
Yeah.
seen a lot of private equity and institutional money go chase those deals.
Yeah. So that's kind of what we're seeing. We haven't seen a dramatic change in Cleveland. It's been kind of going very well for many years for us. We've seen an increase in value of about like 10%, 12% in the markets, the sub markets that we're investing in, all single family. So it's doing very well. The rents are also going up, even in this, crazy time that we live in. We see an increased demand, we see increased rent, and so that's going very well. When we're looking back at Memphis, some of the suburb, the single family there, that's booming incredibly. It's going very, very well. We had one house recently on the market, one single family, and we're trying to rent it, and we had 58 people wanting to rent this that visited that. They said they were interested in that house to 58. And we have apartment buildings as well. We don't have 58 people showing up to go to see an apartment.
Yeah.
So that's just incredible. So when I saw that recently, that's just like, wow, this is what's going on. And then our prices have gone up like significantly also in suburbs of Memphis.
Yeah, we
So,
own 5 assets in Memphis. We're a big fan
uh-huh.
of that market. So
Yeah, yeah. So the other thing, so commercial real estate. So how do you think most of your assets are in office, right? Office towers that you mentioned.
mhm.
So how about the you don't own anything, but maybe you have an idea of what's going on with the hospitality kind of industry and the restaurants and these kinds of businesses. Any idea there on how that real estate market is going to be affected for these businesses?
Yeah, it's just getting absolutely crushed. And I feel terrible for my friends who are in that
Yeah.
business. I think retail, it was already struggling. That's a story that we all know. Bricks and sticks retail was going the way of the dinosaur.
Hmm.
Experiential retail, I think, still makes sense. But those
Yeah.
power center deals where, you've got an grocery anchored strip center somewhere, I just don't see the value there.
Yeah.
And I think it's going to be very difficult to unwind some of those trades.
Hmm.
Hospitality is a different animal. I think, it's just getting severely punished right now, but you can see a world in 3 or 5 years where you picking up things at a steep discount, you can make some real money in that space.
Hmm.
And I've seen some families and some private equity groups be pretty aggressive and risk on
Hmm.
buying up some hotel buildings. The one place that I think I'd be really cautious of is big city convention center anchored hotels. I
Yeah.
just
Yeah.
think that that business is going to be really, really long time coming back.
Yeah.
And
Yeah.
if you're going to take down the hotel deal, pretty much everyone I've talked to says that you need to have about 2 years of carrying costs, and you probably have to buy
Wow.
cash. So that's to use a phrase that probably that's a big boy game. I mean,
Yeah.
that is a
Yeah.
risk on trade where you've got to have high conviction. You really have to
Yeah.
love the deal, and you've got to be in it for the long haul.
Hmm.
But I do think starting in Q1 and Q2, when a lot of these hotel people throw in the towel, give the keys back, and the servicers kind of go through that CMBS special servicing process,
Yeah.
I think there'll be some deals to be had. But there's a lot of private equity with dry powder on the sidelines, so I do
Yeah.
think there'll be some active bidders there.
Yeah. Yeah.
So I'm more bullish on hotel than retail by a large amount.
Hmm. So I guess before we go into the tax topic, so stock market, uh, any kind of dynamics you see happening in the stock market where people are looking at the stock market the way it is right now, and then whether they think it's uncertain, whether they think this is no problem, let's go for the moon. Do you see any kind of people taking their money out and moving it into real estate, or the other way around, or how do you see this the dynamic play out?
Yeah. Again, we have a network of, call it, 500 individuals and families, and we spent a lot of time talking to them during COVID lockdown. Certainly during April and May, there was just a lot of fear. People
Hmm.
were scared. They didn't know what to do. And, a lot of them didn't really understand what was happening. That really changed, I think, after Memorial Day, when the government really stepped in aggressively, the Fed stepped in aggressively,
Yeah.
and at this point, I think some people are looking to take some chips off the table. And the
Hmm.
sentiment, at least seems to me anecdotally, is maybe there's 5% upside left in the market if
Yeah.
if the elections go smoothly, if we do a second round of stimulus, if the second wave of COVID isn't as bad as it looks like it is now.
Yeah.
Those are all catalysts to the upside. But
Yeah.
it seems like there's more downside risk than there is upside risk left in the
Yeah.
market, considering
That's
how pricey it is.
that's how I see it.
The problem is there's no other good place to put your capital right now. Fixed income is terrible. Um, you know, Bonds are not paying anything. Private
Yeah.
credit is really expensive considering the risk you're taking on.
Yeah.
And so if you're looking for a safe place to park capital and make yield, even though this is self-serving, I think commercial real estate is probably one of your best bets, because the traditional dividend paying stocks are all cutting their dividends.
Mhm.
Energy, I think, is really disrupted, and it might
Yeah.
not ever come back the way that we think it is. So I think CRE is still one of the better places to put it. But the market, I mean, it's priced in a lot of good news, in my opinion, and we'll see if that good news comes.
Yeah, exactly. I think they really they seem to be assuming that the best everything is going to happen, that the election is going to be smooth. There's going to be another stimulus package. The virus is going to be found and is going to be very effective and it's going to be on time, and also that the consumption pattern is not going to change. So I mean that's going to be the other thing too. Is that normally if it's just a recession, people they buy certain things, they buy their basket of goods, and then when there's a recession they buy less of these goods, and some goods they don't buy at all, and then the economy comes back on, then they kind of like they bring back their old basket of goods and they keep buying. But now with this pandemic and stuff like that, I think that consumption is gonna change significantly. People are gonna see things a little bit differently. They're gonna travel probably less for the next couple of years. They're probably gonna, still eat out a little bit less, or maybe there's gonna be a spike or something like that. But I can see that their consumption pattern is gonna change.
Yeah, and that's where, the economy is not the stock market. The stock market is not the economy.
Exactly.
The Fed and everything they're doing, they are daring you to not invest in the stock market. They're doing everything they can to push your dollars into the market. Yeah. Because if you've got cash like I do, you've looked like a schmuck for the last 60 days.
Yeah.
Because it just keeps going. Well, because asset prices rise when real rates are this low. So the Fed has done a really good job. We will see if Congress will do their part to help the economy, the real economy out, because you and I both know that the unemployment numbers we see and the GDP numbers we see are not real. It does not reflect what's actually happening on the streets. So I think there's just a lot of fear. For me, I'm very scared to go back into the market personally.
Yeah, me too. I have my money. I'm all cash right now, so I'm just kind of like waiting either for it to go down and then buy a little bit. But yeah, that's kind of how I position right now, which is not a position.
That's right.
But yeah, so that's very good. Thank you for your insight on that. So now let's talk. We have a few more minutes. Maybe we can talk about the tax advantages of owning a direct real estate investment. So a lot of people, they're talking about, they want to invest in real estate and say, but I don't want to be a landlord. And and when we talk about the returns on real estate for the turnkey rental, for example, or the apartment buildings that we sell, we're really talking about just the basic, either the cash on cash return or return on equity at the beginning, or a cap rate or something like that, to give them an idea of what the returns they can expect. But there's another layer below that that deals with the benefits of owning that real estate. Beside appreciation, there's tax advantages that you don't get if you invest in some other kind of investment vehicle.
Yeah, that's right. And one of the reasons I started the company is for commercial real estate, specifically office, there was really a paucity of good opportunities for taxable investors. I mean, so by that, I mean, pension funds and endowments and these things are not taxable. And so the vehicles that they go into, the general partners or the people that run those investments, they do not do things on a tax advantage basis because their investors don't care. And so I think one of the biggest issues is individuals and families need to look at return profile net of taxes and fees, because it makes a really big difference on your gross IRR versus your net IRR, because you should not care what your gross is. You can't take a gross IRR to pay your mortgage or pay your tuition. And so one of the best things about owning real estate directly through a syndication, or if you're your own landlord, is getting that K1, because through accelerated depreciation, cost segregation analysis, how you term the return of capital as opposed to income. I mean, we're able to show losses on a K1 for the first 1, 2, maybe 3 years, and you're getting a double-digit yield. So, Is it going to be bootstrapped on the back end? Probably. But can you offset gains elsewhere in your portfolio with those losses? Yeah.
Yeah.
And it's tremendous. And not to get political, but with this whole Trump tax issue, I mean, he's
I was
leveraging.
hoping you wouldn't bring that up, but no, go ahead.
He's leveraging the laws on the books, right?
Yeah,
And
exactly. Yeah.
taking full advantage of them. And you know, my wife got upset about it when she read this, and I said, we do the same thing. I mean,
Yeah,
the
exactly.
power that the tax code provides to real estate ownership is just incredible. And
Yeah.
if your sponsors aren't taking advantage of it, you need to go look for a different person to run your money.
Yeah. Yeah, I mean, nobody wants to pay extra income tax and stuff like that. And then these advantages are there. So even our single family rental landlord, the people that invest with us, uh, just buying these properties gives you some tax advantages that you didn't have if you have just a regular 9 to 5 jobs. Right now, all of a sudden, there's some things that you couldn't expense that now, oh no, I'm a business owner now. I can expense this, I can expense that. And then even though I'm making a net income because of the cash flow, I'm making a net income on the property, even a single family house, my depreciation on that sometimes offset at least 80% of the net operating income, the net cash flow of that property. So you kind of like, you're making money in the bank account, you're putting money in your bank account, but you're not, that income is being offset by depreciation and other expenses. So you're negative.
Yeah, I mean, I
And
think we all hear the "don't fight the Fed." I think a better one is "don't fight
yeah.
the IRS." Right? The tax code is not a political structure itself, but
Hmm.
it is a set of incentives and disincentives to do certain things.
Yeah. Yeah.
And you should not go upstream against the IRS. You should go with the flow.
Yeah.
And the tax code is meant for you to own more real estate. It is
Hmm.
incentivizing you to do that.
Yeah.
I think you should just embrace it.
Yeah, I mean, when you think about it, I mean, for especially from my perspective, I mean, we are investing. We're buying distressed properties. We're renovating them. We're putting tenants in them and stuff like that. So I feel like I'm really adding value to the economy and providing value to the investors and then the tenant as well. So it's beneficial what I'm doing. But if I can't get the tax advantages that I need to do this, if it becomes like too costly for me to do that, then I'm just going to find something else to do or somewhere else to do it, to do
Correct.
the same strategy. So I think it makes sense. And but I found what I found interesting is that I didn't read the New York Times article, but it seemed to me like they misconstrued or misunderstood or didn't understand that this is how it works for everybody. It's not like I think he did something that were a little bit unorthodox and potentially not entirely legal. And I don't know that for a fact. But a lot of the things that the New York Times were talking about from the excerpt that I saw was, yeah, this is like, yeah, you offset depreciation. Yes, that's fine, and
Yeah, I
you had a
mean,
loss,
you
that's how it
you
works.
you have a carry forward on your loss. You
Exactly.
refinance your properties every 3 to 5 years. I mean, that's all pretty typical stuff.
Exactly.
I'm not going to say I'm not going to opine on what he did or didn't do,
Yeah.
but on a high level, this is what most commercial real estate operatives take advantage of. So.
Yeah. Yeah. So yeah, I didn't. Yeah, I'm not a big fan of Trump, but I didn't see anything that was too alarming and what was reported so far. So, oh well. Uh, any other topics? Any other kind of, if somebody wants to get started in commercial real estate, I guess that would be a good question. Is how do you get started? To me, that seems a little bit. It's a little bit overwhelming, I think, for a lot of the investors that I talk to. The market is not as easily understood as a single family rental or even an apartment building, because and then also, what kind of additional resources do I need in order to go into commercial real estate? Do I need to have, and all of a sudden I have to have lawyers, or do I have to have a special relationship with big companies that would rent my space? So tell me more about that, how
Yeah,
to get started.
yeah. And one of the cool things about what's happening now is this democratization of access to alternatives to individuals.
Mm-hmm.
And whereas 10 years ago, you had to know a guy to get access to the deals, et cetera. Now with LinkedIn and the internet and a lot of these platforms,
Yeah.
all this education resources is free. I mean, if you go to, and this is
Mm.
not a plug, but if you go to our website, I mean, God,
Oh,
we
that
have.
sure sounds like a plug.
Yeah, but it's real, right? I mean, the
Yeah.
reason we do this is we
Yeah,
have,
yeah.
I mean, we have blog pieces, we have webinars, we have podcasts, we have everything you could think of that goes from as
Yeah.
basic as, hey, 7 reasons you should do this to, hey, let's get into the nitty gritty on what, cost segregation analysis is and how it works.
Mm-hmm.
We have everything that spans the spectrum. So if you have time, you can educate yourself for free.
Yeah.
By going through our website or YouTube or LinkedIn, and you can message sponsors or people like me, or you can listen to podcasts like this, and you can learn a ton without having to put any money out there. So that's the first stop that I would do is, leverage some of these resources, reach out to people, use your network, get on the phone with someone like me, and I'll be very open and honest with you about kind of what I think, or I think there's opportunity or risk. And then, once you educate yourself, then you can go to where your conviction is. But I think what you need, and what we talked about first, is you need to have an investment thesis and a framework to make these critical decisions. You need to have a belief system of, hey, I think this is an overreaction because of COVID. I'm a big believer in San Francisco downtown office. I'm going to go all in, or whatever it is. But you need to have some kind of structure to make these decisions, because otherwise it's just overwhelming. There's this universe of opportunities. So I think start educating yourself and then come up with what you truly believe and have conviction in, and then start spreading it around. I would not go concentrated on one play or one thesis. I would, dip your toe in the water, get a feeling of how it works, and then you can kind of reallocate accordingly.
Yeah, for us, I mean, the way we work, we look at it. I mean, our goal was passive income, so that's what we were looking at, and then from that, we looked at all kinds of different strategies to achieve passive income, and then we would look at the resources that we have, and then we start looking at the markets, kind of like strategy, resource, market, and then we kind of like adjust and balance these 3 elements. So of course, if you're interested in cash flow and your strategy is to buy a commercial building in downtown San Francisco, so I don't know if they cash flow or not, but I know that the rentals don't. So
yeah, I mean, I think it's
right?
cap rates are very challenging pre-COVID.
Exactly.
I don't think there's been much of a price repricing post-COVID, and
No.
I think in the near term it's gonna be very difficult. So yeah, I mean, I like the way you put it. Is what is your end game? Are you looking for
That's right.
big home run hitters? Are you looking for big IRR, big multiple? Or are you looking for slow and steady? Really understand your risk profile, and then that'll take you to the investment style and the asset class accordingly. Because if you want to take on retail development, sure, have at it. You can make a ton of money, but it's a risk adjusted return, right? So there's both sides of the coin.
Yeah, and I think that's when you look at your thesis or your idea of kind of like where do you think the market is going to go, or what am I comfortable with? I mean, that impacts then kind of like your market. What market am I going to invest in? It could also impact the strategy, because if I'm thinking commercial is going to be, the office building they're going to go away for whatever reason. Then, I don't want to invest in that. So that's going to affect your strategy in terms of, I don't want to invest in commercial real estate. I want to invest in this, or I don't want to invest in Airbnb or that kind of stuff. So that affects your strategy, that affects your market and all of that. And of course, if you think that commercial, and the way you presented it, it sounds like I'm kind of curious about commercial real estate into these secondary market, then that may be something that I would look at a little bit more and see how they're cash flowing and which market to look at and all of that. But again, the top thing is our goal. Is that going to give me the passive income that I need and stuff? So, well, very good. Brian, famous last words. Anything to add?
Thank you for having me. I mean,
where can people reach out to you?
Yeah, appreciate that. Excelsior Capital. You can look us up on LinkedIn. I'm very active on LinkedIn. If you connect with me and shoot me a message, I'm happy to set up a call with you and talk on whatever subject you want. And then ExcelsiorCapitalGP.com is our website. You can sign up for our newsletter. You can get all of our kind of propaganda that we put out there, and you can see for yourself. But we're very active. We create a lot of content. We'd love to have you come check us out and learn about what we're doing.
Okay, and then I'll put the link in the comment section so people are not going to type this. They just want to click on the link.
I know.
All right, excellent. Well, thank you, Brian. Thank you for sharing your knowledge with us, and I really appreciate it.
Yeah, thanks.
Talk to you later.
Okay.
Take care.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.